Hello and welcome to Stave Talks. I'm Tanushree Banerjee, editor of Equitymaster's Blue Chip Recommendation Service, Stock Select. Once again, my objective in this video is to declutter all kinds of corporate actions, market news, and their implications on your stock portfolio so that your focus is purely on the safety of your portfolio. Now, I'm sure over the past few weeks, you have come across plenty of opinions, news articles, and debates on the stock of ITC. The reason the stock of ITC fetched so much attention was because there are polarized views on whether ITC is a tobacco stock or FMCG stock, whether it's a growth stock or a value stock, and whether it's undervalued or fairly valued. The core problem with ITC is that its subsidiaries have become a drag on its return ratios and its valuations. Its return on equity looks nowhere close to that of its FMCG peers. While the company is directing most of its fresh capital allocation to the FMCG business, some investors still see it as a tobacco stock, which in turn makes it a stock that is not eligible on the ESG parameter. So the question on everybody's mind is that should one be patient until the stock of ITC shows its true colors? And for that, one also needs to know if the company will be able to unlock value from its subsidiaries. Well, there's yet another company which is in a similar quandary, but is already offering some answers. The stock is Mahindra and Mahindra, M&M. And the reason I call it the ITC of the auto sector is because despite its tremendous potential, the stock remains mired in debates about how to evaluate the conglomerate's growth and value. The sheer size of the conglomerate and the challenges M&M poses on the capital allocation and execution front makes it a tough nut to crack for analysts. In case you don't believe me, the group comprises 179 subsidiaries and 30 joint ventures. So I'm not exaggerating when I say that M&M has spread itself too thin over the years. And the impact is evident in the company's stock price, which after a fabulous run from 2002 to 2018 has grossly underperformed its peers over the past 2 years. Now, it's not for nothing that from 2002 to 2018, August 2018 to be precise, M&M was the best performing stock in the Nifty. The key driver was that its financial performance was fabulous. Its earnings grew at 34% compounded and its return on equity was consistently closer to 22%. Plus, there were very strong cash flows. But if you look at the stock today, despite a strong V shaped recovery over the past 10 months, it seems grossly undervalued compared to its domestic peers. And the key reason for that is the performance of its loss making subsidiaries, which have been a big drag on its bottom line. So, M&M is now recalibrating its strategy in a bid to fetch returns on its investments very quickly. The company's management is evaluating loss making businesses across the board to reduce cash burn and prioritize capital allocation to businesses that offer visibility of at least 18% return on equity (ROE) in the near to medium term. This, I think, is a very good move. M&M has already shuttered its US-based electric bike startup Gen Z and Australia-based small aircraft manufacturer Jeep Zero. Most importantly, it has halted capital infusion into its ailing Korean subsidiary SsangYong Motor and is aiming to offload its 75% stake in the company. Again, its American unit, Mahindra Automation North America, has also been halted in terms of more capital allocation, and the company is looking at further clarity on the business model before deciding to offload its stake. So, of all the loss making subsidiaries, the plans to sell SsangYong Motor and electric bike startup Gen Z are top priority. Meanwhile, M&M is encouraged by the performance of its listed subsidiaries, which is why M&M plans to list at least 10 of its subsidiaries in the next 2 to 7 years as it looks to increase its shareholder returns substantially over the next few years. M&M has identified 10 companies across sectors such as clean energy, mobility, defense, financial services, infrastructure, technology to drive growth of the company over the next few years. The 10 companies that M&M could be listing over the next few years are Mahindra Axilo, which is into steel processing, Bristlecone, which is a supply chain company, Mahindra Powerol, which is an engine maker, Classic Legends, which is a two-wheeler maker, Mahindra Sustain, which is into solar power, Mahindra Mobility, Mahindra Electric, and Mahindra Defense Systems. So overall, the plan to consolidate the business, get rid of loss-making subsidiaries, and unlock value from its profitable ones by listing them is a brilliant move and a timely one. And I believe over time, this strategy will help M&M prove itself to be a stock with significant upside, whether you look at from the prism of growth or value. For more such views on safe stocks and asset allocation, please sign up for Equitymaster's free newsletter, The Profit Hunter. I will look forward to your views and feedback in the comment section of this video. Take care. Thank you.